Navigating the intricate world of investment taxes can sometimes feel like solving a complex puzzle, especially when you are trying to optimize your financial outcomes. Yes, capital losses are indeed used to offset capital gains in a very specific order, with short-term losses generally offsetting short-term gains first, and long-term losses generally offsetting long-term gains first. The Internal Revenue Service, or IRS, has clear rules for how these offsets occur, which can significantly impact your tax liability for the year. This specific ordering is designed to ensure fairness and prevent taxpayers from manipulating their tax situations excessively. The IRS categorizes capital gains and losses as either short-term, for assets held 1 year or less, or long-term, for assets held for more than 1 year. Short-term gains are taxed at ordinary income rates, which are typically higher, while long-term gains enjoy more favorable lower rates. This distinction is crucial because the offset mechanism prioritizes pairing similar types of gains and losses before moving on to cross-category offsets, ultimately helping to minimize the higher-taxed short-term gains first. To apply this rule effectively, first, net your short-term gains and losses together. If you have a net short-term loss, it offsets any net short-term gain, reducing your taxable income at the higher ordinary income rates. Similarly, you net your long-term gains and losses. If you then have a net loss in one category, say a net short-term capital loss, it can be used to offset a net gain in the other category, such as a net long-term capital gain, and vice versa. Any remaining net capital loss, after offsetting all gains, can then be used to offset up to $3,000 of ordinary income per year, with any excess carried forward to future tax years. An important nuance here is the concept of a capital loss carryover. If your total net capital losses exceed your total net capital gains plus the $3,000 ordinary income deduction limit, you do not lose the benefit of those losses. Instead, they are carried forward indefinitely to offset future capital gains or ordinary income, following the same offset rules. This ensures that the tax benefit of realized losses is not entirely lost in a single year, providing a valuable long-term tax planning tool for investors. Understanding the specific hierarchy of capital loss offsets, prioritizing short-term losses against short-term gains, allows you to strategically manage your portfolio. This knowledge empowers you to make informed decisions about when to realize gains or losses, potentially reducing your current year's tax burden and planning for future tax efficiency, ultimately optimizing your overall financial strategy and helping your advisory practice thrive.